This is Robert Kraft, and I'm your host for the Planet MicroCap Showcase Virtual Investor Conference 2020. I'd like to thank you all for joining us for our accounting panel. The title of this panel is COVID-19 Ramifications for Small Businesses. I'm very pleased to have everyone who's joining us on this panel today, especially our moderator, this is now his 7th year moderating our accounting panel, Mr. Neil Levine from Friedman LLP. And I'd also like to thank all of our sponsors for this panel, including Friedman LLP, Marcum LLP, Weinberg and Company, and Centri. So with that, Neil, I throw it to you. Thank you all for joining us for this panel again, and the floor is yours, my friend.
Thanks, Robert. Thanks for having us again. So good afternoon, everyone, and welcome to the panel, COVID-19 Accounting Ramifications for Small Businesses. My name's Neil Levine. I'm once again honored to be here as the moderator of this panel and the lead sponsor of the conference. First off, I'd like to introduce you to my esteemed colleagues who I've been fortunate enough to discuss the current events that are happening as it relates to COVID-19. Each of the panelists will have a few minutes or so to tell us about them, their areas of expertise, and their firms. So again, my name is Neil Levine. I'm the co-leader of the SEC practice for Friedman LLP since 2014. We have a firm of 600 employees formed in 1924. Our practice has grown to number 12 in the amount of registrants we do with firms over 100 employees. Of course, we handle audits for registrants on national exchanges and the OTC markets. We have a large international audit practice, which lists us as number 4 in China in auditing US-based registrants with the operations here. And Friedman LLP audits most businesses except for hospitals, banks, and oil and gas companies. So with that, I'm going to introduce our panelists, Corey Fischer from Weinberg and Company. You're up, Corey.
Thanks so much, Neil. It's great to be back on the panel. Thanks again, Bobby, for the invitation. My name is Corey Fischer. I am the managing partner for Weinberg and Company. We are a CPA firm based in Los Angeles. We have a wide-ranging practice. We kind of focus on auditing MicroCap and smaller middle-market companies. We have a lot of our clients are listed in NASDAQ, New York Stock Exchange. I've been involved in a number of equity and offering transactions during the last 12 months. Obviously, it was a very active market for many of us up until the recent events. Previously to Weinberg, I was with one of the big 4 firms for many years. And after that, I was actually CFO for a couple of highly traded NASDAQ companies. So I've got a good background on both the public and private side. Thank you, Neil.
Thanks, Corey. And now I'm going to throw it over to Michael Cohen, who is my partner. And Michael heads up the QC practice for Friedman as well. Go ahead, Michael.
Yeah, thank you, Neil. As Neil said, I'm Michael Cohen. I am part of the SEC practice group, and really the entirety of my practice is involved with public companies, those going public, really middle market microcap space. In addition, I also head up the firm's quality review department. Prior to joining Friedman, I was the CFO for a public company, which really gives me perspective over what a lot of our clients are going through, whether it be dealing with the accounting, SEC, PCOB. So thank you very much. Thank you for having me on the panel, and back to you, Neil.
Thank you, Michael. And now I'd like to introduce panelists for the first time with us. Michael Aiello from Centri Business.
Thanks, Neil. Hi, everyone. My name is Mike Aiello, and I'm the managing partner here at Centri. Like the other panelists like the other folks on the panel today, we are CPAs, we are accountants, but We do not do audits. We do not do taxes. Instead, we are strictly the liaison between the auditors and the companies. We focus on SEC reporting, Sarbanes-Oxley compliance, technical accounting research, and valuations for our clients and companies throughout the country and the world. We have clients of every shape and size that you can imagine, from pre-revenue to multi-billion-dollar companies. And it's a really nice place for us to be because we're able to provide them with expertise on demand. And I can tell you a lot more about Centri here today, and you can certainly check it all out on our website. But instead, what I'd like to do is quickly give a shout out to my team here at Centri and say thank you for all that you do. With everything that's going on in this world today, they haven't missed a beat, they haven't missed a deadline, and that's really just kudos to them for their quality and the experts we have here at Centri. So once again, a quick shout out. Thank you, everyone.
Thank you, Michael. And now it's my pleasure to introduce David Grossman from Marcum LLP. Thanks, David.
Thank you, Neil. Like Neil said, I am David Grossman. I am the assurance partner in charge of the Houston office for Marcum. And Marcum is one of the largest independent public accounting and advisory service firms in the country. We have offices in many of the major business markets throughout the U.S. I think we have currently about 30 offices and then we in the U.S., and then we have some locations internationally as well. We're headquartered in New York City, and we provide a full spectrum of the traditional tax, accounting, and assurance services, advisory, valuation, and lit support. We serve both privately held and publicly registered companies. The firm has about 200 companies that are registered with the Securities and Exchange Commission that we have as clients in total. And in the Houston office, we have about 40 of those. We focus on middle market companies and closely held family businesses. Back to you, Neil.
Thank you, David. So I'd like to start off our conference by just trying to talk about a hot topic, mainly the CARES Act and how it relates to our clients, especially who have applied to and have received funding for the PPP, the Payroll Protection Plan. So with that, I'm going to ask David Grossman to go through and just explain from a GAAP perspective how it would affect the accounting. And before David gets into that, the PPP, most of our clients and the people out there, they've received 2.5 times a monthly average payroll, times 2.5 times. And they've been getting money up to $10 million. So with that, I'm going to throw it over to David. And David, tell us about how it's going to affect our reporting.
Sure. Thanks, Neil. Like you mentioned, one of the government incentives is the PPP loan, but we'll see other government incentives related to this COVID-19 crisis. They'll take the forms of direct grants, subsidies, loans like PPP. There is also the EISL loan that the SBA is doing. And some of these loans are below market interest rates that will need to be accounted for appropriately. And then some of these loans, like the PPP, are forgivable. And we'll see tax credits and some combination of all these different incentives. Unfortunately, in the accounting world, we don't have a whole lot of guidance on government incentives that businesses receive. We do have some guidance in the income tax world of the accounting. Those are the investment tax credits and other forms of assistance that are administered through the income tax regime. They're accounted for under the income tax accounting standards. There's also an accounting standard for nonprofit entities related to revenue recognition. And some of that applies slightly to business entities, but it's not direct accounting guidance for business entities that receive incentives from the government. And so, how should, some of this accounting be accounted, or some of these incentives be accounted for? Let's take the PPP example for a second. It's a loan. It's at 1% interest. There's no payments that are made for the first 6 months. So you have a loan that needs to be accounted for. Depending on how those businesses that receive that money actually pay out that money to either salaries or some of the other eligible expenses, so they expect to get some kind of forgiveness. And so you'll have a forgiveness of loan transaction that happens down the road, but that doesn't happen up front. So up front you have loan accounting that you'll have to determine if the 1% is at a market rate or below market, and there may be some discounting related to that loan because it is deemed to be below market. That discount will have to be amortized over the life of the loan. And then you may have some kind of catch up that happens if there's a partial loan forgiveness. And so there's lots of elements related to accounting that the PPP loan comes into play. I guess the key there is to look for things that are similar in GAAP, since there's nothing specific, and try to make a decision based on the framework that is in GAAP that finds something that's similar to the incentive that that company actually receives.
Great. So with that, I would just like to throw in there for the companies that are watching, from a tax perspective, I got my K-1 the other day, which was amended from 4 weeks ago. And there is an election that 39-year property can be now elected to 15-year property. And that's a nice depreciation a lot of companies could take advantage of. And from what I understand, you can go back to 2018. So there'll be a lot of amended returns. The IRS reinstituted net operating loss carrybacks for 5 years. So I just wanted to throw that out there because that is a ramification for a small company. And with that, I'm going to go to Michael Cohen. And Michael, what impact has or will the CARES Act have on financial statements, as many filers have delayed their 2019 filing? And what kind of disclosures may companies have to put in their financials?
Yeah, thanks, Neil. So the question is a little easy to answer, and then it gets a little bit more complicated. I assume at this point, most of the filers have completed their calendar year financial statements, although perhaps they're taking advantage of the SEC giving some relief to those that were affected by the COVID-19 coronavirus. So it's important to note, though, that the CARES Act should not have affected any financial statements for the years ended in February or prior, except for additional disclosure. GAAP specifically requires that the effect of any changes in tax law be recognized in the period in which the new legislation is enacted. So in the case of the CARES Act, any changes in your deferred taxes or income tax receivables relating to change in depreciable lives, carrybacks, deductibility, those would not be reflected until the period that includes March 27th, 2020, which is the date of enactment of the CARES Act. As we move forward, we would expect to see those changes. For example, for a calendar year filer, they would reflect the changes in the tax law in, let's say, the March 31, 2020 quarter.
All right, thank you, Michael. So with that, some of these adverse events have happened, and I want to go to Corey and ask him, Corey, what are we doing about inventory? What are we doing about accounts receivable? How is, what's the accountants, what do we have to do with our clients to make sure they get this right?
Thank you, Neil. That's a great question. The effects of COVID are going to have a wide-ranging effect on the accounting and reporting disclosures for the first quarter. Current situation is going to specifically affect almost all the recorded assets and liabilities on the balance sheet. I think the first thing that management and the audit committees need to do is to have a dialogue with the auditors to go over a lot of these, because there may be issues out there that you're not even aware of. But I think paramount at first, what the company's going to have to do, it's going to have to prepare forward-looking cash flow estimates, because these cash flow estimates are going to affect the carrying values of almost all the recorded assets and liabilities on the books. Specifically, these forward-looking cash flows are going to affect impairment analysis of your goodwill, of deferred tax assets, and also just about every carrying item. Most importantly, what a company is going to have to assess is the recoverability of the recorded assets and the impairment of the assets on the books. And all of these are kind of based upon cash flow estimates. And how do you make these cash flow estimates not knowing what the future holds? We sit here today and we have significant industries that are completely shut down, like travel, entertainment, hospitality. Real estate industry is a mess, either as a landlord or as a tenant. So there's a lot of issues that are going to have to be addressed, specifically on goodwill, all the recorded intangibles that you may have in the books from a prior acquisition. They're all going to have to be looked at. That's always been a hot topic with the SEC right now. Again, this quarter, you're going to have to do an in-depth analysis of the recorded of your future expected cash flows, and how do you do that in this environment? And I think at the end of the day, you just have to make a good faith estimate, and that's what the SEC, 6 months, 9 months, if anything should happen. I mean, that's what we're going to look at. That's what they're going to look at. But you're also going to have to make these estimates for your customers, because most of us are going to have receivables. Most of us have inventories out there that need to get liquidated. And we're going to have to make an assessment at the end of this quarter on the ability to collect those receivables, especially if they're from a customer in a troubled industry. Whether or not we're going to be able to liquidate these inventories, whether these inventories have spoilage, whether these inventories are subject to technological change, or whether we're selling to customers that don't even exist anymore. All these things are going to have to be addressed in Q1. Q1, most of us are going to have to file by, most of the companies here are going to have to file pretty quickly. The SEC will allow 45-day exemption for those companies that need further time to analyze this. But there's just a lot of uncertainty. So I think, back to it, company, audit committee, management, their responsibility is going to be in developing these key estimates and providing the backup at this time to defend those estimates, 6-9 months from now, if anything should happen. Impairment issues are very delicate, because once you make a decision to impair, you can never write that asset back up. So I think that there's going to be has to be a lot of thought. I think it all gets back to these cash flow estimates. So I would recommend companies now start that process and to begin the discussion with their auditors. Thank you, Neil.
Hey, thanks, Corey. And to piggyback off of that, Mike Aiello, we had discussed, since you do some work for some of our public companies and we work well together, how is this going to affect going concern analysis? Corey mentioned some cash flow and some modeling, which I know your firm really would fit the bill for a lot of the companies out there. So can you comment on that a little bit?
Yeah, absolutely. Thanks, Neil. And I think the first question is, first things first, what is this going concern topic? And for anyone who's not an accountant out there, kind of give a quick overview. So the FASB requires companies to take a look at their position as a going concern to continue into existence for a period of 12 months after the financial statements are issued. And that's an important note. So if you issue your financial statements on 3/31, 4/30, 5/31, et cetera, it's 12 months after that period of time that you're looking forward to. And what the company needs to evaluate is if there is substantial doubt or if there's been any conditions or effects that could lead to substantial doubt about the company continuing as a going concern. And especially in this world that we live in at this point, you know, who doesn't have this consideration to determine if there's some effects or conditions that could impact them? COVID-19 has certainly introduced that into all of our lives. And when you take that a step further, just because COVID-19 is here doesn't necessarily mean that you do have an impact and that you will have a going concern issue. A couple examples. So if you look at some of the most common ones out there, if you look at the producers of the masks or even toilet paper, right now they are not going to be in a situation where going concern, in all likelihood, where going concern won't be an issue. Their cash flows won't necessarily be negatively impacted. However, on the other side, when you think about the hospitality industry, restaurants, bars, airlines, etc., that has certainly introduced a number of questions and considerations that they need to tackle and now look into. So once you've really considered what's going on in the world today, you need to take a step back and determine if you have a substantial doubt about continuing as a going concern. So what you need to do then is document your plan and considerations, and you need to put together your forecasts. And when we think about cash flow forecasting and projection, you know, a lot of folks that we talk to, they say, well, yeah, sure, I did them back in January. Well, we live in a different time now. So utilizing your projections and forecasts from January or even February are no longer applicable. And using any of your projections that are pie in the sky at this point in time, also no longer applicable. So companies really need to take a step back and assess where they're going. And it's as of this point in time for 12 months out. And the one thing we know in this world, especially now, is that it could change. None of us have a crystal ball. None of us can predict the future. But you need to put forth a reasonable effort and take the right steps. Some things that you'd also should be considering in these forecasts are the CARES Act itself. So if you are getting some funds under the payroll protection program, that should be something that is baked into your forecasts going forward. However, as we've talked about on this call earlier, or on this panel earlier, is that ultimately that's only 2.5 months of coverage. And again, this is a 12-month period that we're looking out from the date the financial statements are issued. So the CARES Act can certainly help, and it is a great benefit for a number of companies out throughout this great country. But you also need to look at what else can help you. So perhaps it's the CARES Act plus additional capacity on your line of credit, plus you're having positive cash flows in out months. That could be perhaps an opportunity to provide you've alleviated any concern about having a doubt. And again, it's all back to making sure you can answer that question that you will be surviving and thriving throughout the next 12 months. You know, but no matter what in this scenario, the number one thing that I recommend to everyone is, you know, continue to put your models together, understand your position, try to figure out what you think is going to happen next for yourself and for your clients, as we mentioned earlier, because that can impact your standing as well. Once you put those models together, the next thing I recommend is talk to your advisors and your auditors and have an open dialogue to ensure that you've met all the requirements, you've considered any disclosures that may be required and or necessary, and that they're accurate. And ultimately, the goal when thinking about going concern is making sure that you're giving the readers of the financials accurate information to consider.
Yeah, I'll just cut in for a quick second and repeat what Michael said at the end. And the importance is that companies really need to communicate early and often with their auditors as well, because in the assessment of going concern, in the case of, let's take a restaurant or someone that's really adversely affected, those assumptions and those estimates are going to become significant in evaluating the future viability of the company. And auditors are going to want to participate to understand, when do you expect to reopen, or when do you think the business is going to return to normal? And nobody really knows. So at this point, the best path forward, especially in dealing with a lot of these estimates, is early and regular interaction engagement with your auditors to prevent that from becoming sort of a last minute hurdle to getting filed.
So Michael, more to that effect, in the first quarter when we do these queues for the registrants, I mean, wow, are we going to see more and more just going? I mean, we're going to have to say something about it, right?
I mean, I think at this point, it's safe to say that virtually every issuer is going to include some kind of COVID-19 uncertainty disclosure, whether that rises to a level of a modification of the audit report is going to be based on the facts and circumstances of a client. I think based on some of the public filings that I've seen, a lot of the, let's call them the big box retailers, they are including in the audit report an uncertainty footnote, not necessarily a going concern, just an emphasis of matter paragraph to say, hey, this is a retailer. They're heavily dependent on retail traffic. Right now, that retail traffic is effectively zero. We don't know what that can mean for the future of the company. So that's why I think with every day that goes by, it'll be interesting to see how this evolves. I think every week the perspective changes, but that's why it's important to engage with your auditors early to understand what, and get on the same page as to what they're looking at, what you're looking at, and everyone's comfortable with that conclusion.
Thank you, Michael. So Mr. Grossman, I know there's been some mergers and acquisitions in the first quarter, and stock prices have really taken a bath. So one of the questions I'll have for you is fair value of stock and assets. If management believes the stock price is not representation of the market data for a reporting unit, how are we going to talk about that?
Sure. Thanks, Neil. You have to look at market capitalization, but you also look at other market data to consider when you're assessing the fair value of reporting units, looking at goodwill if there's a potential impairment there. In a depressed economy, declines in market cap represent factors that should be considered in determining that fair value. There may be some repricing risks that need to be looked at, and maybe the current environment says that the risk is higher, so interest rates may be different than what was used in the past. If you're in an inactive market, the market capitalization may not be representative of the fair value. And so other valuation methods need to be looked at and are required to measure the actual fair value of that single reporting unit or the company itself. So determining these factors that affect market capitalization and their impact on fair value requires a lot of judgment. And so it's going to come to the actual facts and circumstances of each individual case that need to be looked at to determine what is the proper fair value to be used when looking at either the value of the company itself or the value of a reporting unit, and looking at the goodwill associated with those acquisitions that happen, not only just recently, but in years past. There may have been a deep dive in the stock price for the company, which indicates that there may be some impairment because of COVID-19 virus. But I think one of the things that's probably fortunate for all of us that stock prices have come back a little bit over the last few weeks. So we have essentially a subsequent event to the March 31 balance sheet dates that we can also look at, that if a company comes up with something that shows that there was not impairment, that if the stock price did come back, then it looks like it's something that was more temporary than a permanent impairment.
Yeah, so help me out. I have a question, right? So let's say stock was issued by a company, David, for the purchase of something, and the price went down like 30%. Do they have to make up the shares? I mean, what are we going to be seeing for, as it relates to mergers and acquisitions?
I think there's the possibility of a company having to issue more shares to a private enterprise that was acquired and the value of the shares that they received weren't what they expected. But I think that's going to come down to what's in the actual legal documents themselves. And they may have to try to renegotiate, with the public company. And so we could see some of that. And if that happens, then that's another transaction that needs to be accounted for. A lot of legal documents don't provide for the issuance of additional shares just because someone didn't get what they thought, the value that they thought they were going to get. And so it's going to, again, I think it's on a case-by-case basis that you have to look at the facts and circumstances of the merger agreement itself and what the transactions that happen after the close and into the future will be.
Great. Wow, that's a great answer. Thank you so much. Jumping around a little bit, Corey, what do we hear about the possible rescission of 404B and market values going down and possibly having accelerated filers who may not be in the same boat? Can you talk a little bit about that, please?
Sure. I mean, in all of this, chaos around us, there was a little bit of good news for the smaller filers, and that's filers with aggregate annual revenue underneath $100 million, that the 404B requirement, which is the requirement to have your internal controls audited, has been rescinded. So those companies will no longer have to incur not only the cost, but the infrastructure necessary to go through the audit. They still are required to have those controls, which are mandated under the 404A. But starting, I believe, for this fiscal year, we're not going to be necessary to have those controls on. So that'll be significant savings to the company, not only for audit fees, but also for all of the outside third parties that were brought in to help oversee those controls.
Is there a market cap ceiling on that panel?
Well, I believe it's based on right now revenue. So it's really, this exemption was designed really to protect the life science industries, or at least that's how they were able to market it, because obviously a lot of equity goes into life science companies and there's not much revenue there, and they wanted revenue that was being invested, spent on developing whatever the product was. So at this particular point, I believe it's just for a company, it's a revenue test.
Okay, thanks, Corey. Thanks so much. Going back to Cohen, hey, Michael, Corey was talking about, the revenue test. What about an obvious reduction in sales for the companies we're going to see, the economic slowdown effect for revenue in 606? And when I say 606, maybe you can explain a little bit about what it is.
So ASC 606 was the new revenue recognition standard. At this point, almost everyone should have adopted it by now. It's not worth, I don't think, going through some of the details, but as you pointed out, in addition to the obvious reduction in revenues, I think some companies, certainly not every company, but some companies could see added complications regarding revenue recognition under the 606 model. And I'll give you a couple of examples where I think it's possible that companies should be aware. The first, and we touched on this briefly, I think earlier, is really that the determination of variable consideration related to those things such as discounts, as refunds, price concessions. That's going to become much more complicated now, because in a lot of cases, companies may not even be sure what those price concessions are going to look like and what they're going to do. So the amount of revenue that can be recognized is really limited to the amount for which it's not, or it's probable that a significant reversal will not occur. So in addition, companies are required to disclose the methods for making those estimates. and they're going to be required to update those estimates to depict conditions at each reporting date. So you've got a case now where at 12/31, a company may have expected a certain level of discount or refund, even as they filed, let's say, in the early part of the COVID pandemic. So they may have estimated a certain level of refunds or price concessions or discounts when they filed in the middle of March. And now, as we head into the May filings for a lot of those Q1s, those same companies may be updating their estimates and may need to adjust some of their revenue related to shipments that occurred prior to 12/31 based on the discounts or refunds that will be taking place. So that's certainly one area where revenue is likely to be affected for the uncertainties around COVID-19. The second is that I think companies, and I have had some clients have conversations about this, some companies are expected to provide extended payment terms to their customers. And to the extent that those payment terms, usually now, depending on if they accept that a practical expedient, but if those payment terms exceed a year, they may be considered a separate performance obligation in the form of financing terms, and that'll need to be accounted for separately, and that'll change some of the revenue model. And then the third way I think companies could be adversely affected has to do with, and this is, again, depending on the business, they may all of a sudden find themselves providing new performance obligations, such as things like warranties, implementation services, or service contracts. So depending on how a company's relationship with its customers and its deliverables change, that might dictate a change in its revenue recognition model from what it had been historical. So I think that's something that companies need to be aware of. And again, it may not affect everybody, but just something to think about.
Hey, thanks, Mike. So I want to throw this back to the other Mike, because you were talking before about liquidity and some cash flow. But what about, like, what are you doing for companies with modeling? I mean, I know this just happened, but modeling, projections, how do we know these companies are going to survive?
Yeah, great question for sure. And certainly a very relevant question these times that we live in. And, you know, I think everyone here has talked a little bit about how these forecasts, how modeling and forecasting could impact impairments, going concern, and so many other considerations. A loss of revenue, that could certainly impact your forecasting and your modeling. And, you know, as accountants, we're really good at being historians, at looking back. And that is really critical in order to put together a solid baseline for where you're going in the future. But in these current times, it's really important to really take a step back and consider where you're going to be impacted at your company. And to an earlier point as well, where your customers, what industries you service, how they may be impacted. And when you take those considerations in, you should be baking all that into your model. You should be going through and determining what ifs. What if you start getting paid on 60 and 90 days? What if there's some of your customers that don't pay you at all? There's a lot of what ifs that you should be asking yourself. And when you go through and you bake that all into the model, again, this should be much more about a reasonable outlook on what your company will be doing going forward. And it's certainly not a time, as I mentioned earlier, for a pie in the sky. You should also be looking for opportunities of, as other finances come in, how can that impact your cash flows? When you're looking at your discounted cash flow modeling, how could additional future inflows help you? That's very important. So again, whether it's under the payroll protection, whether there's any capacity on your line of credit, any of these other things are going to be really important. And, you know, everyone is certainly focused on cost-cutting measures right now. There's plenty of considerations of how that works, how it could impact your workforce. But there's also opportunities to pivot. So if you've really forecasted out your position as a company, there could be opportunities to pivot, to be more profitable, and who knows, maybe even grow, maybe even take advantage of this as well. We certainly know that when black swans fly into people's lives, entrepreneurs at times are able to pivot and take advantage of it. So the more you model, project, and stay ahead of what could happen, the better off you'll be. This is really critical too, that if you want to do any financing or consider any of these accounting measures, Having your forecasts, being able to go to your bank with them and showing that you have some sense of being able to predict some form of the future, that is critical that you're going to get lending going forward in this world. And again, the key really is going through and determining all the what ifs, what could happen to you. And the thing that I really recommend to companies, and this is kind of going off topic for a second, but I recommend everyone put together a worst case scenario model. What is the worst thing that could possibly happen? Put that together and then start evaluating with your colleagues, with your executive team, what would you do in that scenario? And if that day ever comes, you'll be prepared. You'll be prepared to execute on what the next steps will be. If it never comes and it's only a slight decline or a slight impact to you, then you'll all but psychologically look at that as, well, at least it wasn't the worst case scenario. And again, you will be more prepared to weather any storm and hopefully even grow. The other thing I always recommend is update your models often, especially in a scenario like this. Whatever we're even looking at today, it's going to change. As we hear the governor, mayor of the state of New York and the city of New York City coming and pushing back certain deadlines of when we're all going to go back, update your models. This is not something that you can just set and forget it. Very, very critical. And again, nothing is more critical right now than a focus on the future. And that's forecasting. That's projecting.
Thank you, Michael. That was nice. Thank you. Corey, how you doing out there?
Good. It's interesting.
So,
that was a great synopsis, Michael. It's going to be a very tough quarter for everyone, for the investors, but who are invested in these companies, for management, and for the auditors. And as I sit here looking forward to the next 3 or 4 weeks, auditors are always in a funny situation because we're theoretically a gatekeeper, and as all this is going around us, we're ultimately going to be responsible, for these numbers that go into the Q1, or maybe you have a March 31st year end. And there's normally the biggest issue we have is when we do our audit, subjectivity. So many judgments, estimates made in financial statements, and we've never had that more than what's going to happen in the next couple of weeks. And that, and then on top of it, you're going to put in the time pressure to get this filed. Most companies still are going to want to file timely. There's going to be a lot of pressure on us. There's going to be a lot of pressure on management. And when I look at this, it really comes down to some key elements that are going to hit in the fourth quarter and the first quarter. There's going to be the impairment issues, which really are going to be based a lot on these cash flows that Michael talked about. And once the company makes an impairment decision, that's irreversible. You can't come back if you impair goodwill. Goodwill is kind of tied to workforce, and if you have all these employees and you laid them off and you do this acquisition, you've got major considerations there because it's going to be hard to rebuild these workforces so quick. Next issue is going to be reserves for inventory and reserves for receivables. And that, as auditors, I'm a little concerned about because we don't know. And one of the things auditors are always concerned about, or the SEC always gets concerned about, is management of earnings. It's going to be a disastrous first quarter for everybody. Now we've got to worry about whether they're over-reserved because they're going to just try to catch it up in the next quarter. There's all sorts of contracts out there that are being modified. Just like Michael said with some of these customers, you may change some of these contracts, lease agreements. Landlords are giving concessions. If you're a real estate company, people aren't paying rent. I mean, all these things, it's just impossible to go through. So I think the best course, management, auditors, just make your best effort, document what you're doing on both sides. And I think you've got to be completely transparent in your MD&A disclosures. And unfortunately, we're not going to have a lot of ability to see what the other companies are doing. Lots of times the smaller companies kind of follow what the bigger companies are doing. And we're not going to have that opportunity this So it's going to be a very interesting, unusual, difficult quarter. And then on top of it, we're all working remotely, and we're not going to be able to get as much information as we normally would have if we were able to be at the client, we were able to see the invoices. I mean, we're in the process of doing audits right now, and you can't get the underlying documentation because there's nobody there to pull it. It's going to be interesting 2 weeks.
Thanks, Cor. David, when we were talking offline over virtual coffee the other day,
Yes.
you had said that there may be some new accounting standards. I'm sure everybody would like to hear about them that have not been adopted yet.
The biggest one, I think, right now is the accounting for leases for private companies. The FASB's delayed that implementation once again. It was to take effect for private companies and private not-for-profits for fiscal years beginning after December 15th, 2020, which would be for calendar year companies next year. And then interim periods with fiscal years beginning after December 15th, 2021. The proposal, which I think is in the final stages of being approved if it hadn't been approved already, the effective date now will be for fiscal years beginning after December 15th, 2021, which means calendar years 2022. And how this impacts some of our public company clients is those that are emerging growth companies, or EGCs. If they've elected to use the extended transition period, well, then they don't have to adopt leases until 2022, again, assuming a calendar year company. And so that at least takes one thing off the table for them for a while, that they don't have to comply with the accounting standard for leases. And then there's some other various standards that have also been delayed that will help these small businesses focus on, some of the things that are more important related to the coronavirus, instead of trying to adopt new accounting standards while their primary thrust is to survive. And then the Government Accounting Standards Board has also deferred many of the accounting standards that they have for those that are related to the government side of the world. So I think, the FASB and others have taken a look at, what's happened in the last couple of months and helped the small businesses. And like we mentioned earlier, the change in the accelerated filer status will help several of the smaller companies that were accelerated previously that will no longer be accelerated. So again, I think it allows them to hopefully put some of their time and efforts into things that will help them survive, rather than things that may not be as important as survival.
Thanks, David. So anyway, let's move right along. So Michael Cohen, can you think of any other, it's been tough. What is the real challenges for us as a group up here? We talked about, clients, are they going to be there or not? But as, the guy who does a lot of marketing for the firm, I've gotten a ton of new business opportunities. And I think really looking, the registrants are really trying to knock down the pricing. But what else have you seen in the accounting firm as a guy who really makes some policies for us that are happening out there, that I'd like to see what the other guys are doing as well?
Well, I think there's a couple. I would really split the question into two. The first is from, I think, all of our perspectives, we're limited by our clients and our clients' ability. So as Corey kind of pointed out, if companies are unable, they're not technologically savvy enough, or they're not working from home and don't have the ability to do that, our ability to do our job and get the underlying information to complete an audit or to get answers to our questions, it's heavily dependent on the client being able to provide that. If the client can't provide it, then we sort of have a problem doing our job. So that's number one. But having said that, to the extent that companies are capable of working remotely or providing that information electronically, at least for my part, and I think the other, our colleagues on the panel would agree, auditors sort of by nature are a little bit nomadic. We're used to working from client locations, from office locations. So I think our audit practice itself is not as terribly impacted by our inability to make it into the office every day. We're still able to do our audit and conduct our job from these remote locations, provided the clients are able to do that. And I think that's critical. I mean, truth be told, we didn't have very many clients that sought to take advantage of the SEC relief. Most of our clients filed timely. I think a lot of companies file timely with the year-end audit. And I would expect it to be even easier, let's say, for the review. I think that as we go forward, for example, we have a couple of March year ends, things like physical inventory observations are going to be a little bit of a challenge. We're using technology in that regard. So it depends on if clients have sufficient controls, but there's a lot of talk now about using video cameras, FaceTiming, security camera access, things like that towards trying to take physical observation of inventories where maybe the client location is closed, maybe because of travel restrictions, we can't get an auditor to that warehouse to take that physical. So I think that's where technology is going to fill in some of the gap. And then, to the extent that, and this is more so in some of our private jobs, if they don't have that technology and we don't have that access, that's, I think, where as auditors, there's a little bit of a struggle. Either companies are looking to IPO, maybe delayed in the process because of their inability to meet the filing requirements. But I think that at least that's where I see it. And I'm not sure if any of the panelists have a different take.
Anyone want to comment? Great. So with that, I personally want to thank our panelists. And I'll throw it back over to David Grossman. And David, to wrap it up, just tell us, how we can get in touch with Marcum if we need to. And then I'll go to Corey, Mike, and then we'll wrap this up. Thank you so much.
Sure. Thanks, Neil. Again, my name is David Grossman, assurance partner in charge of the Houston office. And you get in touch with Marcum on our website is marcumllp.com.
Thanks, David. Thanks a lot. Mike Aiello, how are you?
Good. Thanks again, everybody. And my name is Mike Aiello from Centri Consulting. If you want to get more information on us, you can go to www.centriconsulting.com.
Great. Corey.
Thank you, Neil. Corey Fischer, managing partner of Weinberg and Company. Our website is www.weinbergla.com.
Thanks. And Michael, tell us how we can get a hold of you.
Thank you very much. You can get in touch with Neil and I through our website, friedmanllp.com. Thank you very much. And feel free to reach out, email me if you have any questions.
I got one audience question for you guys because, we earlier today had the legal panel, and much similar to them, you guys were also in the trenches, with these issuers, helping them through this process from an accounting perspective. So, I have to ask, what are some of the most frequently asked questions you've been getting from issuers right now, and how are you answering them? So, go around. Neil, we can start with you and then go from there.
Well, as I'll say the relationship guy, most of the questions I've gotten most recently is, Levine, we need to get money. Can you help us guide us through the PPP? And what we've done is we've developed a great spreadsheet, which will show them how they could ask their bank at the end of the 2 months to get forgiveness on this loan. But personally, most of my questions for the last 2 weeks, have just been about what's out there, how can we get it, Medicare stimulus, et cetera, et cetera.
Got it. And then Michael Aiello?
Yeah, I think, some of the stuff we covered here today, when you think about the going concerns, the impairments, and then of course, forecasting and money, making sure that they're going to have enough people to keep all their folks employed, that they won't need to do layoffs or furloughing. That's a lot of the conversation that happens that I'm part of. From an accounting perspective, audit, financials, especially private companies, the big question is what the heck goes into my subsequent event footnote, and really helping them disclose that as well.
I mean, got it. And then Corey?
Yeah, I mean, it's a good question. I think that a lot of companies right now are just focused on trying to make it to the next day. Whether it's the pending financing through the government programs, whether it's dealing with workforce issues, they're just overwhelmed. And I think right now, companies are beginning, it's April 16th, 17th, as we speak. Companies are just completing their first quarter close. The next 2 weeks are going to be very interesting,
To say the least, right? So, and then David?
Sure. Thanks, Bobby. I think the number one concern is how do I survive? As a small enterprise, with several of these companies having to either lay people off in a furlough or reduce staff. If things come back to what we used to know as normal, how are we going to find the people with the right talents if I've had to lay people off? And, even if they were in a furlough, they may have found a job another way somewhere else. And how do I survive? And then when it comes to the accounting side, I think it's again, the impairments of assets and goodwill.
Got it. And then finally, Michael Cohen?
Yeah, by far the most common question I've gotten is what David really just hit on, which is how do I deal with impairment issues? My stock price is down, my revenues are not meeting their targets based on what we thought they were going to be when we did the estimates at December 31 or whatever our last measurement date is. So everything is trending down in the near term. We still believe in the company long term, but how do we incorporate some of these short-term hurdles into our estimates? And what does that do for impairment? And I think that is by far the question that I seem to be getting the most from CEOs, from CFOs, from board members, because they're trying to manage around their communication strategy also.
Right. I mean, actually it's interesting. Sorry, one more question, because that actually hits on another question I had in listening to the panel was, changing business strategies. You're seeing a lot of companies now taking a lot of their business online. And, as Michael Aiello has said a lot during this panel, I mean, there's a real huge need for more forecasting and trying to understand how changing their business strategy completely or even modifying it a little bit. So I guess I'll throw this last question to Michael Aiello. I mean, how are you helping some of these companies? I'm assuming you are helping these companies that are now having to face some of these new business strategies and then having to implement these new forecasting so that, as you said earlier, also can help potentially get some more lending down the road.
Yeah, good question. So first and foremost, it's being there for them, listening to them, hearing their concerns. They know what makes their business tick. They know how to turn a profit, and us listening and trying to have them be more creative of how they can pivot to use technology to be more profitable in the future. Maybe there's certain service lines or products that, while using more technology, can be more profitable. Maybe there's certain service lines that we're failing all along anyway in lower margin areas. Maybe there's a way to tweak that, or maybe maybe you're being told something that service is no longer a value to your customer base in the future. And any of those scenarios, it's an opportunity to pivot. It's an opportunity to take advantage of this and look towards the future.
All right. Well, with that, thank you guys. I really appreciate you guys taking the time to do this. This was a lot of fun.
Thanks, guys. I really enjoyed it. Thanks so much.
Thank you, everybody.
Thank you.
Thanks, everybody.
Thanks, guys.